Have you ever stared at a stock chart, watching the price zig and zag, and wondered what's really going on behind the scenes? It feels random, right? A green candle, then a red one. But what if I told you that every single price move, no matter how small, is telling a story? It's not just noise, it's a signal. Today, we're going to dive deep and uncover the hidden signals beneath the price moves. Think of the price like the tip of an iceberg. What we see on the surface is just a fraction of the story. The real action, the bulk of the iceberg, is submerged, invisible to the untrained eye. And that invisible part? That's the volume. Let's break it down. Price tells you where the market is going, but volume tells you how it's getting there. It's the fuel, the conviction behind the move. Imagine a stock price slowly inching up. Okay, that's interesting. But now imagine that same price inching up on massive, record-breaking volume. Suddenly, it's a completely different story, isn't it? That surge in volume is a huge signal that big players, the institutional investors, are getting involved. They're the ones with the power to truly move the market. When they buy, they don't just dip their toes in, they make waves. So how can we spot these signals? Let's look at a classic pattern. You see a stock that's been trading sideways for weeks, maybe months. The price is flat, the volume is low and boring. It's like the market is asleep. Then, one day, boom, the price breaks out of that range, and at the exact same time, the volume bar on your chart skyrockets, maybe 5 or 10 times the average. That is not a coincidence. That is a signal. It's the market waking up and screaming, "Pay attention, something has changed." That high volume breakout often signals the start of a new, powerful trend. The smart money has made its move, and the price is just beginning to react. Now, let's flip the script. What about signals at the top of a trend? This is where things get really fascinating. A stock has been on a tear, climbing higher and higher. Everyone is euphoric, convinced it's going to the moon. You might even see the price push to a new high. But if you look closely at the volume, you might see something strange. The volume on that new price high is actually lower than the volume on the previous highs. This is called a divergence. The price is saying one thing, but the volume is whispering another. It's a sign of weakness, of exhaustion. The buying pressure is drying up. It's like a car trying to drive up a steep hill but running out of gas. It might sputter a little higher, but a reversal could be just around the corner. This is often how major tops are formed, not with a bang, but with a quiet fade in participation. The opposite is also true at market bottoms. During a panic sell-off, prices are plummeting and fear is everywhere. You'll often see a day with a massive spike in volume, a huge red bar. This is called a climax volume or a selling climax. It looks terrifying, but it can actually be a bullish signal. It represents capitulation, the moment when the last of the weak hands finally give up and sell, no matter the price. And who do you think is on the other side of that trade, buying up all those shares? The institutional investors, patiently accumulating at bargain prices. After that climax, the selling pressure is exhausted, and the stage is set for a potential reversal and a new uptrend. So the next time you look at a chart, don't just look at the price. Look beneath it. Look at the volume. Is the volume confirming the price move, or is it telling a different story? By learning to read these signals, you'll stop chasing random fluctuations and start understanding the real narrative of the market. You will be able to see the footprints of the big players and get a glimpse of what they're doing before it becomes obvious to everyone else. It's a skill that can transform your perspective on the markets. The influence of a Federal Reserve chair extends far beyond interest rate announcements and press conferences. For businesses, particularly those dependent on leverage, refinancing, or long-duration investment planning, central bank leadership quietly defines the boundaries of what is economically viable. The silver market's retracement reflects an early-stage reassessment of these boundaries, prompted by uncertainty over how the next leadership phase at the Federal Reserve will approach the cost of capital. At its core, central banking determines the price of time. Interest rates are not merely a policy tool, they are the discount mechanism through which future cash flows are valued. When markets attempt to anticipate a change in Federal Reserve leadership, they are implicitly revaluing future earnings, debt sustainability, and investment risk. Silver, as an asset sensitive to real interest rates rather than nominal ones, reacts sharply to these reassessments. A retracement often signals that markets are temporarily assigning a higher probability to tighter real financial conditions. For entrepreneurs, this distinction is critical. Nominal rates can remain unchanged while real rates rise if inflation expectations fall or if policy credibility improves. In such an environment, borrowing becomes more expensive in real terms, even without headline rate hikes. Silver's behavior reflects this mechanism. As expectations shift toward a more disciplined monetary stance, the opportunity cost of holding non-yielding assets increases, leading to short-term pullbacks. Historically, transitions in Federal Reserve leadership have been accompanied by subtle but meaningful changes in policy emphasis. Some chairs prioritize financial market stability, while others emphasize inflation control or institutional credibility. These priorities shape not only rate decisions, but also balance sheet policy, regulatory posture, and crisis response thresholds. Markets attempt to price these differences well in advance, even when information is incomplete. The resulting uncertainty compresses risk-taking across multiple asset classes, including monetary metals. For businesses, the consequences materialize through credit availability. Banks tighten lending standards not only in response to actual policy changes, but in anticipation of them. If a new Fed chair is perceived as less tolerant of inflation or speculative excess, financial institutions adjust behavior defensively. This leads to higher spreads, stricter covenants, and reduced appetite for marginal borrowers. Silver's retracement can therefore be interpreted as an early reflection of tightening financial conditions, rather than a reaction to immediate economic weakness. This dynamic disproportionately affects younger firms and capital-intensive enterprises. Established corporations with strong balance sheets can absorb modest increases in financing costs. Emerging businesses, however, operate closer to the margin. Their growth assumptions are often predicated on continued access to inexpensive capital. When the monetary environment becomes uncertain, these assumptions weaken. Strategic plans that appeared viable under one cost of capital regime may become fragile under another. Silver's role in this context is diagnostic. Unlike equities, which can remain buoyant due to earnings narratives or buyback activity, silver responds more directly to changes in real rates and liquidity expectations. When it retraces during a leadership transition, it often signals that markets are recalibrating their tolerance for leverage. This recalibration occurs quietly before defaults rise or investment slows. By the time such effects become visible in economic data, the adjustment is already well underway. Another layer of complexity arises from the Federal Reserve's balance sheet. Asset purchases and liquidity facilities suppress volatility and lower funding costs across the system. Expectations regarding the continuation or reversal of these policies are heavily influenced by leadership philosophy. A chair inclined toward balance sheet normalization introduces a different risk profile than one comfortable with prolonged intervention. Silver AS retracement reflects uncertainty over whether extraordinary support measures will remain a structural feature of the financial system. For decision makers, the key risk lies in complacency. Prolonged periods of accommodative policy condition businesses to treat low financing costs as a permanent backdrop rather than a cyclical variable. Leadership transitions challenge this assumption. Even if policy ultimately remains supportive, the transition period itself introduces volatility in expectations, which can disrupt capital planning and investment sequencing. The warning embedded in silver's behavior is therefore forward-looking. It suggests that markets are reassessing not only the direction of rates, but the philosophy governing them. Businesses that understand this distinction can adapt by stress testing assumptions, extending maturities, and prioritizing liquidity resilience. Those that ignore it may find themselves exposed when financing conditions tighten incrementally rather than abruptly. Silver is not predicting an imminent policy shift. It is signaling that the cost of capital is being reevaluated. In an environment where monetary leadership is in flux, this reevaluation can persist longer than expected. For entrepreneurs and executives, recognizing this phase early is less about forecasting exact outcomes and more about preparing for a narrower margin of error. The retracement in silver cannot be fully understood without addressing the structural tension at the center of modern monetary systems, the conflict between political incentives and central bank independence. While central banks are formally insulated from electoral cycles, their leadership is not selected in a vacuum. Markets recognize that appointments to the Federal Reserve reflect broader political priorities, and it is this recognition that introduces uncertainty during transitions. Silver ES behavior during such periods often reflects a reassessment of whether monetary policy will serve institutional credibility or political expediency. Presidents do not appoint Federal Reserve chairs at random. Each selection carries implicit expectations regarding growth tolerance, inflation management, and financial market stability. These inferences are rarely precise, but they shape capital allocation decisions long before policy actions occur. Silver's retracement reflects this inferential phase, where probabilities are adjusted rather than conclusions reached. The core issue is credibility. Central banks derive much of their effectiveness from the belief that they will act consistently, even when such actions are politically inconvenient. If markets suspect that a new Fed chair may prioritize short-term growth or asset market support over inflation control, inflation expectations can rise. Conversely, if the appointment signals a renewed emphasis on discipline and normalization, expectations adjust in the opposite direction. Silver, sensitive to these expectations, reacts to the perceived direction of credibility before it reacts to actual policy. This dynamic creates a paradox for political leadership. Governments benefit from low borrowing costs and accommodative financial conditions, particularly in environments of elevated debt. However, excessive accommodation erodes currency confidence and distorts capital allocation. A Federal Reserve chair perceived as politically aligned may offer short-term relief at the expense of long-term stability. Markets understand this trade-off and attempt to price it in real time. Silver's retracement suggests that investors are uncertain which side of this trade-off will dominate. For businesses, this uncertainty translates into strategic risk. Political pressure on monetary policy tends to surface most clearly during economic slowdowns or periods of market stress. If the next Fed leadership is perceived as more responsive to political demands, markets may initially price in continued support. However, such support often comes with rising inflation risk and eventual policy instability. If instead the leadership is perceived as prioritizing independence, markets may brace for tighter conditions even if growth slows. In both cases, the transition phase introduces volatility in expectations that directly affects investment planning. Silver ES role in this environment is instructive because it occupies a space between monetary asset and industrial input. Unlike gold, which is primarily a store of value, silver's demand is tied to manufacturing, technology, and infrastructure. This makes it particularly sensitive to policy paths that influence both inflation and growth. A retracement during a leadership transition suggests that markets are unsure whether future policy will favor reflationary growth or restrictive stabilization. Until that uncertainty resolves, silver often trades defensively. So the historical record reinforces this interpretation. Periods in which central bank independence is questioned tend to coincide with greater volatility in monetary metals, not because policy outcomes are immediately negative, but because the range of possible outcomes widens. Markets dislike wide distributions of risk. In response, they reduce exposure until clearer signals emerge. Silver's retracement is consistent with this behavior, reflecting a narrowing of risk appetite rather than a definitive judgment. For entrepreneurs and executives, the lesson is not to predict political outcomes, but to recognize their monetary implications. Businesses that assume central banks will always act as stabilizing forces underestimate the constraints imposed by credibility and inflation. Conversely, businesses that assume immediate tightening may overreact. The more prudent approach is to acknowledge that leadership transitions temporarily weaken the signaling function of policy, increasing the likelihood of mispricing and sudden adjustments. This is particularly relevant in an environment where fiscal policy and monetary policy are increasingly intertwined. Large deficits amplify the sensitivity of governments to interest rate changes, increasing the temptation to influence monetary leadership. Markets are acutely aware of this interaction. Silver's retracement reflects not only uncertainty about the Fed chair's philosophy, but about the broader balance of power between fiscal demands and monetary restraint. Ultimately, the tension between political incentives and monetary independence does not resolve quickly. It evolves as policy decisions accumulate and credibility is tested. Silver's current behavior suggests that markets are withholding judgment, waiting to see whether institutional norms will be reinforced or eroded. For business leaders, this waiting period is not a time for complacency, but for reassessment. Strategies that rely on stable, predictable monetary conditions are most vulnerable when those conditions are in question. Have you ever wondered about the hidden potential of silver? It's not just for jewelry or fancy tableware. For centuries, silver has been a cornerstone of global finance, a safe haven asset, and a critical industrial metal. Today, we're diving deep into the world of silver, exploring why it's more than just gold's less famous sibling. We'll uncover its unique dual nature, its historical significance, and why some experts believe we're on the cusp of a major silver boom. So stick around as we unravel the shimmering secrets of this fascinating precious metal. Let's start with a quick trip back in time. Did you know the word silver is nearly identical to the word for money in at least 14 languages? That's no coincidence. From ancient Greece to the Roman Empire, silver coins were the backbone of commerce. The famous pieces of 8 used by pirates, those were Spanish silver dollars. In the United States, the Coinage Act of 1792 established a bimetallic standard, legally defining the dollar in terms of both silver and gold. For most of human history, silver wasn't just a store of value, it was money. This long and storied past gives silver an intrinsic, time-tested value that few other assets can claim. Now, let's fast forward to the present. What makes silver so special today? It's all about its dual identity. On one hand, it's a monetary metal, just like gold. When economic uncertainty looms, investors flock to silver as a hedge against inflation and currency devaluation. It's tangible. You can hold it in your hand, and it has no counterparty risk, unlike stocks or bonds. This is the safe haven aspect of silver that gets a lot of attention. When you see news about geopolitical tensions or financial instability, you'll often see the price of silver react as investors seek shelter from the storm. But here's where it gets really interesting. Unlike gold, which is primarily used for investment and jewelry, over half of all silver demand comes from industry. This is silver's second identity. It's a critical industrial commodity. In fact, silver is one of the most versatile elements on the planet. It has the highest electrical and thermal conductivity of any metal, it's highly reflective, and it even has antimicrobial properties. These unique characteristics make it irreplaceable in a vast array of modern technologies. Think about the device you're watching this on right now. Whether it's a smartphone, a tablet, or a computer, it contains silver. Every switch you flip, every circuit board, and many electrical connections rely on it. The automotive industry is another huge consumer. Your car has dozens of silver-based components, from the heated windshields to the engine control units. And with the rise of electric vehicles, which use even more silver than traditional cars, this demand is set to accelerate. But the biggest story in industrial silver demand is renewable energy, specifically solar power. Solar panels work by converting sunlight into electricity using photovoltaic cells, and the most efficient way to conduct that electricity is with silver. A typical solar panel contains about 20 grams of silver. As the world pushes for a green energy transition and countries install gigawatts of new solar capacity, the demand for silver is projected to skyrocket. This isn't a maybe scenario, it's a fundamental shift in our global energy infrastructure, and silver is right at the heart of it. So we have this fascinating dynamic. On one side, you have investment demand pulling silver up during times of economic fear. On the other side, you have industrial demand, driven by technological innovation and global growth, pulling it up during times of economic prosperity. This dual demand driver is what makes silver so unique. It can potentially perform well in almost any economic environment, something very few assets can boast. Let's talk about supply. Where does all this silver come from? About 80% of silver is mined as a byproduct of other metals, primarily lead, zinc, copper, and gold. This means that silver production isn't always directly responsive to silver prices. If the price of silver shoots up, miners can't just decide to produce more silver. They have to mine more of the primary metal, which depends on the demand and price for that metal. This inelasticity in supply can lead to dramatic price movements when demand suddenly surges. For years, we've had a structural deficit in the silver market, meaning we've been consuming more silver than we're mining. This gap has been filled by above-ground stocks like government reserves and recycled scrap. But those stockpiles are dwindling. We're approaching a point where this deficit could become a serious problem, creating a classic supply squeeze. When surging demand meets a constrained supply, basic economics tells us that prices have only one way to go, up. Now let's compare silver to its more famous cousin, gold. The gold to silver ratio is a classic metric used by precious metals investors. It simply tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has been around 15 to 1. In recent years, it has hovered anywhere from 60 to over 100 to 1. Many analysts look at this historical discrepancy and see a massive undervaluation. They argue that silver is poised for a major correction, where it will outperform gold and the ratio will move back toward its historical average. While past performance is no guarantee of future results, this massive deviation from the historical norm is certainly compelling. So, what does this all mean for the future? We're looking at a perfect storm for silver. We have growing investment demand from people seeking a hedge against inflation and financial turmoil. We have explosive industrial demand from unstoppable trends like 5G, electric vehicles, and especially solar energy. And we have a constrained and inelastic supply that's struggling to keep up. It's a powerful combination of factors that has many experts feeling incredibly bullish. We're not just talking about a small price increase. Some market analysts are predicting a future where the demand for silver, particularly from the green energy sector, fundamentally reprices the metal. Think about it. What happens when the world absolutely needs a commodity for its energy transition, but there simply isn't enough of it to go around? We could see a scenario where industrial users are forced to pay whatever it takes to secure their supply, driving prices to levels we've never seen before. Of course, it's crucial to remember that all investments carry risk. The silver market can be volatile, and prices can go down as well as up. It's important to do your own research and understand your own risk tolerance before making any investment decisions. This video is for informational purposes only and is not financial advice. But the fundamental story for silver is undeniably powerful. Its unique role as both a monetary metal and an indispensable industrial commodity places it in a category of its own. As we look toward a future that is more digital, more electric, and more focused on sustainability, silver's importance is only set to grow. It's the metal of the past, the present, and the future. Whether you see it as a financial safeguard, a bet on technological progress, or simply a beautiful, intangible asset, the story of silver is one that every informed person should be following. The next decade could be a truly transformative period for this humble, shimmering metal. Don't be surprised if silver finally steps out of gold's shadow and into the spotlight. Thank you so much for joining us on this deep dive into the fascinating world of silver. We hope you found it as enlightening as we did. If you enjoyed this video and want to learn more about the markets, finance, and the economic forces shaping our world, make sure to hit that subscribe button and turn on notifications so you never miss an update. We'd love to have you as part of our community. Thanks for watching, and we'll see you in the next video.